Chapter 4. Cover, and Chapter 4 is not that. Chapter 4 is on ratios. And the ratios are on the second tab there. And these are just all the ratios that the book gives you. Now I want to just talk a little bit about ratios and what they're used for. Ratios are important because they they are useful. For identifying trends in operations. They help identify whether they are the company's doing good or bad, and then also they help them compare businesses to others that are similar or even that are dissimilar. So it allows, no two companies are the same. So for instance, Walmart and Target, I always use as an example. They're in the same kind of business, but they're not the same. They're different sizes, they have different philosophies, different all kinds of stuff going on. So there are no two businesses that are the same. So it helps them analysts compare businesses that are similar, Walmart, Target, but it allows them to kind of break it down into more concrete ways of figuring out how they're doing. A few things about ratios. Ratios are not standardized. Different authors will often use different calculation for the same ratio. And I tell you this because you may have in a different class, have a different book that has ratios with different criteria in the calculations. They may have different things in the calculations for them. That's very common. Use whatever the book, if you're going through the class, obviously use whatever the book says, because that's what the answers are going to be based on, is what they say. But also, it's I don't know, I'll go back to it, but analysts can use whatever calculations they want. When they're analyzing something, it isn't you have to do this, that, and the other thing. However they do it is fine. They'll use their experience and whatever to do it. So analysts are free to use whatever calculations they wish when they're analyzing a business. So there is no one right way to do the ratios. And there's no one right way to analyze the business. And you'll have the best analysts in the world, and they'll disagree on a stock. Some will say buy the stock, some will say sell the stock, some will say hold the stock. These people have PhDs, they've been in business for years, highly respected, using the same data, and they'll come up with very different recommendations based on it. So there is no one right way to analyze a business. Okay, and lastly, while ratios identify problems, they will rarely indicate a solution to the problems. And what I mean by that is, you might find that they're being less profitable, but how do they become more profitable? That's the hard question. Telling somebody to go make more sales is kind of like telling an athlete, hey, go win the game. It doesn't really work that way. You have to have a way of doing it, and the ratios themselves won't tell you that. Okay, let's go ahead and get started on the problem. So here's the ratio sheet, and pretty much every ratio in the book is on here. And the ratios, they also have a little description on each of them. It'll tell you what they're for. Oops. So if you're wondering why do we do this ratio, this will tell you kind of why you do that ratio. Okay, let's go to the problem. So problem 1. And again, I think I said this before, but ratios are kind of like making a cake. They tell you to go get this or go get that, and you do it. Column width is not right. Right either. I'll have this fixed before I send it out to you guys. Okay. So return on shareholders' equity. So we're going to use this data over here. So they have net income minus preferred stock dividends. So the author, that's what they have for their return on equity. Most people just use net income, but net income minus preferred stock shareholders, stock dividends. Okay, here is an important note. Assume any missing accounts have zero balances. So there is no account over here for preferred stock dividends. So the assumption is made that they don't have any. If they did have them, they would be in the problem. Okay, so we're gonna go grab the net income for year one. We're gonna grab the shareholders' equity for year one. As our return on shareholders' equity is 3. I did this wrong. Hold on. That's not the income. Sorry. That's more like it. That's not more like it. Okay. Let's go to year 2. So our shareholders' equity, or net income is 6. Our shareholders' equity is 23. I think these are supposed to be in percentages. Just so you know, usually if you see a return on something, it usually indicates that this is supposed to be in a percentage format. Usually. So same thing here, return. Return. They're usually going to be in a percentage format. Okay, so let's go to the second one here, return on assets. Okay, we don't see an interest expense, they don't give us a tax rate, so we'll just use the net income. And the total assets are and we'll do the same thing over here. Okay. Return on sales. Income over sales. And net income. Oops. Income. Okay. Now, whenever you have, ratio and there's good stuff on top, you want it to be as high as possible. So any of these returns, you want them to be higher. So higher is better. So 26 is better than 20. Uh, 10 is better than 6. 15 is better than 9. I'm going to do something here. I'm going to copy this down. Okay. So coming down here, asset turnover. We have sales over the assets. So let's say equal to sales over total assets. Coming over here, say sales over total assets. Okay, again, this one, good stuff on top. We want sales. Sales are good. So we want these to be higher if possible. So 0.73 is better than 0.71. And total assets to shareholders' equity. Three. Okay, so kind of going down here, this is kind of what you do as an analyst. You'd say, okay, are they doing better in year 1 or year 2? They're doing better in year 2. Better in for the return on assets. They're doing better for the return on sales. In year 2, sales are good. We want, if you have sales on top, we want the more of them, the better. So this is a little worse. And assets to shareholders' equity. This is a little bit tricky one. Probably worse. It really depends on kind of what they're trying to do with the company, but it would certainly be more. It really depends on the ratio. I'm going to take that worse off because it really depends on what the. Another weird thing about if you wonder what's the best ratio for liabilities and equity, which is basically what they're talking about there, because it's either the assets equal liabilities plus owner's equity. So they say, well, okay, well, what's the best ratio for liabilities versus equity? And when they do the models, they find out that there is no better way to do it. The riskier company is, the higher return they have. The more safe they are, in other words, if they don't have any debt, the less return they have. So it generally automatically compensates for it. Okay. Let's go to problem 2, or yeah, problem 2. Okay, cash plus marketable securities. Cash, marketable securities. divided by total assets. Cash plus marketable securities over total assets. So they dropped a little bit here. Now this is a kind of a weird ratio anyways, because it's kind of hard to say, but it looks like their cash to their assets, part of their assets is going down. And you can kind of see that, right? Those are cash, those are down. Quick ratio, cash plus marketable securities plus accounts receivable. So we're going to do all three of these. So this is going to be the quick ratio. This is a very common one, quick ratio. Okay, so quick ratio is how quickly can they get the cash and to pay off their liabilities. And it looks like they could pay them all off. Let's go to the next year. So quick ratio, you want the higher the better, and this one is not bad. It looks like it's going up a little bit, so this will be better. Okay, current ratio, also a very popular one. Current assets divided by current liabilities. Current assets divided by current liabilities. So that one they actually got better at. Okay, I'm going to copy this down. Keep it on the same page here. All right. Long-term debt to total assets. So long-term debt plus the current portion of long-term debt. So get those two. To total assets. I'm not sure if that's supposed to be a percentage or not. My gut feeling is it doesn't, but I'll leave it. Okay, total assets are at. So we have less long-term debt total assets, so the company's a little bit more secure, probably not quite as profitable. Okay, long-term debt, but current person to sell executive. Okay, well, one thing we can do here, if we already have this up here, and we do, we can just copy that one. No use in going through the calculations again. And total equity, shareholders' equity. Okay, net income before taxes plus the interest expense. Okay, so this will be equal. Oops. Let's put something on that. Divided by the interest expense. This is something this is called times interest earned. So we earned our interest 14 times, almost 15. And we'll do the same thing over here. So 16 a little bit better. I'll go 3 at a time. So these are the first 3. And feel free to pause the video if you need to. And those are the last 3. Okay. The last one here. I'm going to go ahead and move this down. Okay. Receivable turnover. That's sales divided by accounts receivable. Oops. Okay. And over here, I'm going to format these. I already did this. When I send you guys this out, these will be formatted better. Okay. Net sales over accounts receivable. Okay, now coming down to this ratio, you'll notice something. We have 365 divided by net sales divided by accounts receivable. Net sales divided by accounts receivable is this up here. This is just the turnover. And so this is in days. Okay, cost of goods sold. Divided by inventory. Cost of goods sold. Divided by inventory. And again, we're simply going to that's it. And again, you'll notice that this is the same as that. Okay, that's it. I'll see you guys next chapter. I'll clean this up before I send it to you guys. Okay, talk to you later. Bye.